Good evening, ladies and gentlemen, friends and family. It's wonderful to have you all here tonight. I'm very glad that those of you that are here managed to make it through the traffic. Apparently it is a bit rough out there, so wonderful to have you here with us tonight. Mike and I will be spending the next hour or so sharing some thoughts with you, and then, as always, an opportunity for questions. We will also be recording the session tonight, so not only will the presentation go up on the website, but the recording of the audio will also be available on the website. So by all means, take notes if you want to or need to, but don't feel like you have to write down every single thing that comes up on the screen. And then afterwards, of course, something to eat and to drink. So thank you very much for being here with us. I'm afraid I am the bearer of bad news tonight. I'm going to talk to you a little bit about performance in 2016, not just in the local market, but certainly the currency, I think, is where a lot of the activity in 2016 resided. Offshore investments, balanced funds in particular, and then looking forward to this year and beyond, 2017. What's in store, what to do now. You know, by the way, if you haven't seen sort of what your investment performance over the last year has been like, I think I'm going to give you a bit of a preview tonight, and this comes across the board, where there's hardly any investments over the last year, and it's actually the last 3 years that have given you any form of sort of decent performance. And yes, let's come together with an action plan. We need to trump our New Year's resolutions. Got to do better than New Year's resolutions. So that's what we're in store for. So going back to about a year ago, what did we expect for 2016? So those of you that attended our similar seminar last year about the same time, the title of my presentation then was Staying Afloat. Because I don't know if you recall, but this was just in the aftermath of Nenegate. We were all feeling like we were drowning. The things were really sort of going down the hill and down the drain very fast. And it was all about strategies to just keep your head above water, just to survive. And in fact, I referred to the storm clouds on the horizon that was building and really not being very positive or optimistic about the year ahead. And you'll see that I referred to these as low tide conditions. And low tide conditions really referring to the type of performance returns that we had seen in markets and that we certainly were expecting for 2016. And right at the end, I sort of tried to encourage you not to be swayed in terms of your long-term investment decisions and strategies by short-term events, and not to let the noise in the market affect your emotions in terms of your investment. So, where are we now? End of 2016, beginning of 2017, what surprised us in 2016? Well, there certainly were a couple of surprises, not just us, I think many others were also surprised. And I think the first big surprise came in June last year with Brexit. And I absolutely love this little thing that tells us that Brexit will be followed by Italy, check out, finish, Slovak out, Latvia, bye Jim, Luxembourg, Portugal, Denmark, not spa in, but spa out, Austria, Poland, and then only one country will remain in the EU, and that will be Romania. Lovely bit of tongue-in-cheek in terms of something which is probably one of the biggest political events in recent times, not so much just Brexit, but the future of the European Union, and with it also the single currency. And this is not over by any stretch of the imagination, and nobody really knows how UK's leaving the EU will play out. So that was the first major event. The other major event of 2016 was on local shores, and maybe not all of us were surprised, but I think there were some of the politicians in the country that were a little bit surprised. And I just love that, because I thought that, you know, towards the end of the year, I also sort of wish this year could come to an end, but then I thought that maybe there are some people for whom 2016 was even more of an annus horribilis than it was for me. And then, of course, somebody who misinterpreted the term orange is the new black. And the US went and they elected Donald Duck. as the president, and as I like to refer to him and his cronies, Trompie en die boksombende. I'm showing my age here very much. But you know, when you put these three massive major political events into the equation, and you look at this and you say, what does this mean for investment markets? What does this mean for my investments? You can appreciate why 2016 certainly was not a great year for any of us. So let's put that into context and maybe just look at different investments and what happened. I'm going to start with the South African equity market, because if you had invested 100 Rand in the all-share index, the JSE all-share index, at the end of 2016, your 100 Rand would have increased to a massive 102 Rand and 63 cents. So that 2.6%, bear in mind, is an index performance. That's not even an investment in the market. So it's before any fees or any costs or anything of the sort. And that 2.6% is certainly way below inflation, of course. But let's break that out a little bit, because the all-share index really talks about all the shares that are listed on the JSE, and there was quite a big divergence in terms of performance. From the 28.9% return that was achieved by the resources index, significant positive performance there, all the way to the negative performance of almost 8.5% down for the industrial index, the former darling of our investment markets. And you can see from that range, with property and financials hovering around the flat to 10% mark, certainly a lot of range of performance in terms of your investments. That was a one-year performance. How does this look on a three-year basis, so slightly longer term? And I'm afraid not all that much better, because although money invested in December 2013, 100 Rand would have grown to almost 120 Rand, that represents only 6.2% per annum over the last 3 years. Inflation. Basically, on a real basis, over the last 3 years, your investments in the equity market have really just kept pace with inflation, not much more. And interestingly enough, when we split this out between the different major sectoral groups, that 14.65% sits in the property, the listed property sector, that gave you almost 15% per annum on a compound basis over the last 3 years. And as excited as we might have been about the 29% return in resources, including that 29%, over the last 3 years, resources, mining companies, are still down basically by over 11% per annum over the last 3 years. So yes, great to look at the performance of last year, but to appreciate that it came off a very, very low base of years prior to that. So certainly not much to get excited about in terms of South African equity markets. And what caused a lot of the pain that we saw here? Well, a lot of it was really currency related. And not just Rand related, but currencies in general. So if you look at 100 Rand in dollars at the end of 2015, 1 year later, that was down 11.3%. Of your 100 Rand, you only had 88 Rand left if that 100 Rand was in dollar terms, invested in dollars. And even if you split that out, that Rand dollar actually was the best amongst the major currencies. In fact, no surprise for many of you to know that that biggest decline was a cut of 25% in the pound. So of course, the result of Brexit and the impact that that had on the pound in particular, and with that, any investment that was made into the UK stock market or into pound-based investments, as we find many of our large companies listed on the JSE, London-listed companies, that was down 25%, just the currency effect of that. So you can see a source, or a big source, of this level of underperformance in the market and where it came from. Over the last 3 years, the numbers look a little bit better. So your Rand dollar improved by about 9.4% per annum. But again, this incorporates this poor year that we had last year, just reminding us of how extremely weak the Rand was relative to the dollar during 2014 and 2015. And if you look at it relative to the pound and the euro, you realize that actually over the last 3 years, any investments in pound and euros have essentially gone sideways or slightly flat. So what used to be one of the mainstays also for many South Africans in terms of investment performance, which was almost bargaining on the Rand to depreciate, to give us almost that feeling that our investments have performed better, certainly did not work for us in 2016. And that weak currency effect is the direct contributor to what we see in terms of most offshore investments. So after Nenegate and the end of 2015, where a lot of people ran out and said, got to get my money out this country, this place is going to the dogs. Well, unfortunately, most of those actually were a lot worse off a year later, because your investment in just global equities around the world down by 6.6% for the year, and again with quite a variation in terms of the different regions that we might look at. Interestingly enough, the best performance of international markets came from other emerging markets, down just 2.7% in rand terms, compared to, not surprisingly, the UK down 15.5% in rand terms. Big aspect of that currency, but you can see that the decline in the UK market in rand terms certainly a lot less than the currency impact, showing you that the underlying international markets actually gave quite good performance last year. But when you measure them in rand terms, they really have decimated valuations and performance. Over the slightly longer term, the picture does look a little bit different. Global market performance, about 9.4% per annum, overall in global markets. And interestingly enough, when we look at that top performance, this is the reason why so many people love investing in the DBX tracker USA, because over the last 3 years, 16.3% compound return. And there could very well be more of that, thanks to Trompie and die Boksomwende, but certainly the risks are increasing. Worst performance out of that, not surprising to see that it's the UK. So again, coming back to the idea that the bulk of the JSE, of the all-share index, size-wise, market cap-wise, is determined by the valuations of the companies listed in London. So really sort of giving you an idea of why the performance over the last 3 years have been as poor as they've been. But many of us would be invested in balanced funds. So whether that is your pension at work or a retirement annuity, or whether it's even a unit trust investment or a portfolio of ETFs for that matter, balanced funds really is the way that most money is invested in this market. And unfortunately, at this level, the picture is the bleakest of all of them. Because 100 Rand into a balanced fund over the last year hardly registered on the scale. These are based on the average ETFSA multi-asset categories, and whether you look at low equity, medium equity, or high equity, in fact, the low equity portfolios performed the best of the three of them. And the high equity, where the majority of longer term money would be invested, certainly not only way below inflation, but also negative once you take investment costs into consideration. So don't be surprised when you get your next pension fund statement or your RA statement and it shows you that your performance over the last year has been flat to negative. And even over the last 3 years, although those numbers slightly higher, between 6.1 and 6.7% return per annum over the last 3 years, in the context of an inflation that's also sitting at around 6%. So again, balanced fund investments really in the last 3 years have gone absolutely nowhere. No wonder people are wanting to run for the doors and say, why bother? Why am I even in this investment market? This is just a waste of time. I should rather just spend my money. So, what should we do now? Where does this leave us after 3 years of such lethargic and sluggish performance? So I want to sort of share with you some very long-term history in terms of the all-share. So this is a graph of the all-share index going back to 1960. And this is done on the actual index level. So not only can you see the significant growth that we've had in recent years, that's the 2008 crash that we had there, but you can now clearly see this sideways consolidation phase that we've experienced over the last 3 years, where the market essentially sitting between 50 and 53,000 and not really moving much from there. But such a long-term graph on a nominal scale is a little bit misleading. One actually needs to look at it on a logarithmic scale. And the only thing that the logarithmic scale does is it means that between any 2 points, you can get a much better idea of what the growth is. So the nominal might be doing this, but actually the growth, you can see, is a much more stable picture that you're looking at there. And in fact, over this long-term period, the average real return, so after inflation has been taken into account, it's been 11% for the all-share index. That's 11% higher than inflation. And that is why we encourage long-term investments to go into the equity market, because it's the only sustainable way that one has the opportunity to actually perform better than inflation and allow your money to actually grow faster than the negative effect that inflation has on your wealth. So when we look at something like this, what can we expect for the next 3 years? Now, this scatter plot, what I've done there is to say, looking over that 56-year period, when I look at the return over a 3-year period, the most recent 3-year period, what is the typical return that I get over the next 3-year period? And what we've seen from the history is that after a period of very poor performance, typically you would get much higher performance. So this trend line that I've got there really says that the higher your recent return, the lower your return over the next couple of years will be. And the lower your most recent return, the higher your next return will be. And in fact, on average, after a period of effectively zero return on a real basis for the all-share index, on average over the next 3 years, the market goes up by 50%. That's just the history that tells us what happens after such a period of consolidation. And what about the shorter term? What if I was only to look at the next 1 year? Well, even the 1 year picture on average, you're looking at about an 18% return on average. It can be higher, it can be lower, but over the longer term, those are the sort of statistics that we see for an investment in the market. And that is why it's so important that at a time like this where one feels despondent and where you feel that, you know what, this is just not worth it, I'm wasting my time and I'm wasting my effort, why this is exactly the time where one needs to fuss bait and actually say, you know what, I'm in this for the long term, and this is not just the industry trying to convince me to remain invested, but this is for my own wealth benefit. So what are we expecting from 2017? So I can run you through a long list of views and expectations. Things like equity markets are expected to be recovering in South Africa, supported by a rand that is expected to resume its weakening trend in the second half of this year. Inflation is expected to moderate thanks to the fact that oil prices have stabilized and certainly the worst of the drought seems to be behind us. That takes pressure off interest rates. Lots of uncertainty, specifically political uncertainty, with 3 major conferences coming up this year on the ANC political calendar, and that leads to policy uncertainty, which essentially means GDP might improve marginally, but it is still going to be too low to dent employment. On the international front, I might tell you that I think in the US, fiscal stimulus is going to replace monetary stimulus. So it will be tax cuts, it will be direct infrastructure investments, rather than low interest rates. US and emerging markets, especially the likes of India and Turkey, is expected to lead global GDP higher, so more than one engine of growth in the world. King dollar is expected to remain strong because of the fiscal stimulus that Trump will be bringing into the US monetary policies, and that will be good for exporting countries like Japan, for example, like parts of Europe, in fact. But inflationary pressures will be building around the world, which is not necessarily a bad thing. In fact, that is exactly what central bankers have been trying to achieve over the last couple of years since the global financial crisis. Commodity prices have already improved a lot, but they will to some extent be capped. Those gains will be capped by a strong dollar, but also by still excess supply and not sufficient demand in the world. And there will be the continued rise of nationalism and protectionism, impact sort of in terms of global trade in the world. But you know what? I can go through all of this. I can spend the whole hour just talking about this. And actually, I want to say to you, so what? What does all of that have to do with your and my investment strategies? Why should we even bother with that? And I'll tell you that I don't believe that we should bother with that. We shouldn't be concerned about that at all. So what does a proper investment action plan look like? Not just for 2017, but beyond as well. The very first thing you have to have in place is an emergency fund. You don't want to have to sell investments at a time that you don't want to, just because you've got some crisis or disaster, the geyser bursts, or you need new tires on your car, or your kids need new teeth, or straightened teeth, whatever the case might be. So that emergency fund, so incredibly important. Please do not invest in the market until you have an emergency fund in place. Emergency fund, probably 3 to 6 months of your most important monthly expenses. That's typically what you're going for. And that you don't invest in the market, that you keep in an interest-bearing account. You're just in a savings account where you're just going to get interest. You're not interested in trying to get a high return. You want to know the money is there when you need it. That's the purpose of that investment. The second thing you look at is your tax-free investment. In particular, if you are younger, because you don't want to be investing in a tax-free account for the short term, because you're going to be using up your annual or your lifetime allowance, but not get the benefit of the compound effect of the after-tax returns over a short period of time. So this is something for the longer term, and it's particularly good also if you're not somebody that currently pays income tax. Maybe you earn below the threshold, or whatever the reason might be why you're not paying income tax at the moment, you definitely then want to first invest in a tax-free investment before anything else. Retirement savings? Well, retirement savings, there might be some people for whom it is worthwhile to first invest in retirement savings before they max out their tax-free account. But you really want to use your retirement contributions first and foremost to reduce your current tax burden that you have. So if you think in terms of contributing 100,000 Rand to a retirement annuity, and if you are on a 30% marginal tax rate, for example, it means that is an extra 30,000 Rand tax that you're not going to have to pay, which immediately funds your tax-free account. So even though I'm saying there are some cases where it's best to first invest in your retirement savings and your RA before the tax-free, what I'm saying is use the tax savings that you get from your contribution to your retirement annuity or your pension fund to fund your tax-free investment, because you really do want to have both of those in later years when you're looking at different tax-efficient drawdown strategies. And only then and only then, do you think about a discretionary investment. People are so keen to rush out and first open the stockbroking account or the discretionary investment account or the unit trust that they go for, or even, God forbid, forex trading. This is the very last thing that you should be doing in terms of your order of priorities. Because if you don't first cover the emergencies and the tax-free benefits that are given to you, you're really sort of wasting opportunities that are given to you by government. So make use of those opportunities and leave the discretionary investments for the very last thing, only when you have excess money available to invest in that. In closing from my side, how do we avoid making emotional investment decisions? We are so confronted not just by actual factual noise in the market, but now apparently we live in the era of, did you know what the word of 2016 was? Post-truth. I must admit, I had to go and figure out what does post-truth mean. I guess it's a little bit like Donald Trump's advisor, Kellyanne Conway, who yesterday spoke about alternative facts. So here are the facts, but you know what? We've got alternative facts. So yes, we are confronted by all of this. It becomes even harder to be discerning about what is real and what is not real. And so how do we avoid making emotional decisions? And the important key here is to focus on yourself, to say, what is my investment goal? What am I trying to achieve with my investments? And how do I devise a plan that will help me reach my investment goals? Design such a strategy, either on your own or with our assistance. Very importantly, then stick to that plan. Don't be swayed by what happens in the market to steer you away from your investment plan that you've devised. The second thing is to focus on the things that you can control. You and I can't control the interest rate increases in the US or what the governor of the Reserve Bank does in terms of interest rates. We can't control whether Trump cancels trade policies or not. We can't control commodity prices. So although that's all the news flow that you hear, we can't even control the elections, although you should still vote because you can contribute to that outcome. But we can't control the outcome of those things. So let's focus on the 3 C's that you can control. Costs. It's the one certain thing that you've got in your investment equation. So the lower you can have your investment costs, the better your performance on an after-cost basis will be. The second thing is you can control your contributions. You can control how much you are investing, adding to your investments, either on a regular monthly basis or on a lump sum basis. You can control those contributions. You can also control your consistency. the consistency with which you stick to your plan and not be swayed by what's going on around you. So the other two C's, the two C's that you should not do is the chopping and changing. Stick to your investment plan, irrespective of what's happening in the market around you. Get an investment buddy. Almost like the Alcoholics Anonymous, where if you feel you want to drink, you've got somebody that you can call. If you feel that you want to start meddling in your investments, have a buddy that you can call and say, you better stop me now because I'm going to sell the stuff. Or that investment buddy could be us, who can assist you in terms of that first point, designing your goal and helping you to stick to it. But get somebody to go on this journey with you and help one another to stick to a very well-devised investment plan. And finally, I'm a market commentator myself. I know that I'm part of the problem here in terms of commenting on intraday, day-to-day events. But please, the majority of that news flow, I want you to acknowledge it for what it is. It's entertainment. It's not something that you should base investment decisions on. It's entertainment. Sometimes that entertainment is a bit of a horror story, but you know what, if you can go and watch a suspense thriller movie, I guess you can also watch some of the news flow. But watch it for entertainment. Look at, and if it bothers you, if you don't like watching thrillers or sci-fi movies like I, then don't watch it. Don't look at it, because actually it has no bearing on your investment strategy and how you are investing according to your well-defined goal. So, I've got 3 messages for you. Number 1, stay invested. Don't be tempted because of the very poor recent performance to say, I'm just going to throw in the towel, this is not worth it. This is exactly the time. This is that time, what do they say? It's the darkest just before dawn. This is the time where tenacity builds long-term wealth. Stay invested. The second thing is to keep investing. Keep investing on a regular monthly basis. Keep investing into your tax-free account, into your retirement annuity, into your pension fund savings. Do it on a regular basis, because doing it on a regular basis means that you get that rand cost averaging. You will be buying some of your investments at a higher price and some at a lower price. And it's that discipline and that rhythm of doing it on a regular basis that builds wealth over the long term. And finally, invest more. When you get that annual increase, if you're lucky enough to do that, don't think that lifestyle creep means that your expenses have to increase to match your new income. Try and stick with the expenses as you have, and whatever excess is available, invest more, because that's how you build wealth for the long term. You might say, how actually? Well, that's why I've got Mike coming up next. We're going to leave the questions until after Mike has spoken, but Mike's going to share with you how and where and what do you use to actually do these sort of investments. So, Mike, over to you.
Okay. Well, thanks, Karina. Thank you very much. Right, I'm Mike Brown. I'm the other bit of the ETFSA. And Narina's had the first word, so I get the last word for once. That's great. So, right, using ETFs, ETNs, and portfolios to build up your wealth. Yeah, the old crowd, people who used to run the world, used to say inequality is, is really what you want is a bad thing. You really want equality. You want building up wealth's a bad thing, etc., etc. Well, Trump and his power, his cronies seem to think that wealth's a good thing. So I think we'll find a very different environment globally. Lower tax rates, much more conducive structures for investment and so on coming out of Trump, hopefully, the sort of stuff he's talking about. So building up your wealth is no longer a bad thing. So what are we going to talk about? Well, critical issues in wealth management, why ETFs, ETNs are good wealth management tools, diversification, talk about that a bit, putting it all together, building blocks using exchange-traded products, passive investments, as a way of building portfolios. I'll show you some actual portfolios and performance, and us managing portfolios for you, doing it yourself. We'd have a little bit on tax-free accounts, and we'd have a little bit on retirement fund products at the end. So quite a bit to get through. And Narina kept on her time, 30 minutes. Well done, Narina. So I'm under pressure here. Right, so critical issues in wealth management. And this is sort of simple stuff, but I mean, I'm a simple bloke, and I'm sure you aren't. But there's a couple of things just keep in mind. Investment is all about time. The longer you're invested, the more over time you will make money, compound interest and all the rest. So start investing as early as possible and make time work for you. And also don't give up investing too early. I'm 55, I'm too old to save money and invest. Rubbish. You're going to live till 95. You've got to keep on investing for a long, long time to make your capital work for you. So the longer your capital's working for you, the better. And this is quite simple, but it does mean preserving. You leave your company, preserve your retirement funds. Don't go and blow them on a nice holiday, Mauritius and all the rest, and get a suntan like Charmaine. Go and spend as little as possible, but preserve your capital, keep investing for as long as possible. Invest on a regular basis. If you can just keep on investing all the time, debit orders are a real friend of yours. $300 a month, $500 a month, 3,000 Rand, whatever I can afford. After a while, I don't miss that debit order. After all, I'm paying that debit order of a couple of grand a month to watch DSTV, and the Proteas, now funny enough, they're winning, but Bafana can't win. Do I need to keep on? But the debit orders are something that you're doing all the time. And just do that for investments. Get in the habit of investing on a regular basis. And the third one really is that investment is a habit. Any long-term investor coach will say, just make investment a habit. Save 10, 15% of your income on a regular basis, and do that as something that's just as a matter of course. Whether you're doing it in debit orders or whether you're doing it in lump sums, just get in the habit. And there's good habits and bad habits. This one's a good habit. So pay yourself first. Before you pay anybody else, just go and put your money into your investments. If I can't afford it this month, that's fine. Well, I'll do it next month. But just get in the habit of regularly putting some money away. And if you start when you're young, like all the girls here on the front row, I'm not too sure about some of the blokes at the back, you start young enough, if you just get in that habit, that's all you need. You don't need retirement funds. You don't need all the luck at the end of your career. Just putting money away on a regular basis when you're young solves all your retirement problems. Solves all your wealth problems down the road because you've got time working for you. Compound interest. You've seen some of the numbers that Darina showed for longer term investments. Diversification, very, very important. Don't have all your eggs in one basket. A lot of people say diversification is diversification, but it isn't. You can't forecast. Nobody can forecast what's going to happen. Narina said what we thought was going to happen in the beginning of last year and what happened was completely different. Nobody, no matter how clever people are, nobody can really forecast developments in investment markets or developments in the broader world. So you want to be exposed to all the different assets because some of them are going to be performing, like resources last year and cash last year. And you don't want to miss that. So have your investments as broadly diversified as possible, and over time that will pay off, and I'll show you some numbers on that. Just get into the habit of doing diversification and keep your costs as low as possible. So funny enough, Narina and I, for repeating ourselves here a bit, we did our presentations independently because she's been running around and I've been running around, but we're saying the same sort of stuff. But costs are a massive, massive factor. Just go back to that one. And cost is something that nobody really discloses properly. Because in any investment you've got, there's a product cost. What does this unit trust cost? What does it cost, this ETF cost? What does this RA cost? What does the product cost? What are the trading costs? I've got to buy and sell this thing. Even if I go and buy a unit trust manager and says there's no trading cost, there is a trading cost. He's got to create those units for you. There's a cost in trading those units. There's a cost in selling those units if you want to sell it to. So trading costs always come into any investment. Trade at the lowest cost you can. Intermediary costs, are you sitting on a platform or list or something like that? What does that cost? Structure costs. Generally speaking, try and avoid structures if you can. Don't buy structured products. Don't buy endowments. Don't buy things that are structured because an investment is just an investment. In the end, you're really just buying a couple of shares or a couple of indices and all the rest. You don't have to have it in a complicated structure. So try and avoid that. And advice fees, also, you do need advice. You'll need consultation and all the rest. Now, all those are fee structures in virtually any investment. Yet very few people tell you all of those. So you've got to go and do an investigation. What is this investment really costing me? And that unfortunately means you've got to start reading the terms and conditions and all the rest. Most of us go and sign a form and there's 3 pages of terms and conditions, small writing. We won't worry about that. Go and read that. I'll talk about that a bit later. So costs are a critical factor in investments. Why are ETFs, ETNs good wealth management tools? Well, they give access to an index, and an index is just a portfolio of shares. The top 40 index, or the industrial index, or global index, they're just a portfolio of shares measured by an index which measures the performance of that whole portfolio. And if you're buying an index, you immediately have diversification because you're buying a whole portfolio of shares. You buy the top 40 index in South Africa, you've got mining shares, financial shares, property shares, industrial shares. Your index gives you diversification for a start. Diversification, very important tool in investment. It reduces your risk because the more spread you are, if you buy one company, there's always a risk. Something's going to go wrong with that company. Or it could go right, but you don't know. But the minute you're spreading your investments into an entire index, that index reduces your risk. And it lowers your costs because instead of buying all 40 companies in the top 40, you just buy Satrix 40 and you pay cost once. You don't pay cost 40 times if you had to go and buy those 40 shares individually. So the cost structures of ETFs, ETNs are very low. And that's a big important factor, as I said earlier, trading costs, structure costs, and so on. ETFs, ETNs, they trade on stock markets. Big deal, you might say, but that means they're completely transparent. We know exactly what the price is, and they trade all day long at different prices as the market goes up or down, as the index moves up or down. They have low costs because they can't track an index with high costs, otherwise they'd mistrack the index. Who's going to buy an index tracker that mistracks the index for 1 or 2%? But you buy an index tracker that mistracks the market by 10 or 20 basis points. That's where most indices trade at. Whereas you go and buy a typical unit trust, which costs you 2 or 3%, that guy's going to mistrack the index, the performance of the market by 2 or 3%, unless he's smart enough to pick shares that will recover those costs for him. And he can't always do that. So your index at low costs reduces your risk, but it automatically has low costs. And all the things that you tend to pay with on platforms, settlement, custodianship, depositories, that's all built in when you buy any share on the JSE, including ETFs, ETNs. You go and buy a share in the JSE, let's say Satrix 40, it costs you 12 Rand to the JSE in terms of straight fees, settlement fees, custodianship fees for the rest of your life. Okay? Now, if you buy a million Satrix 40s, it still costs you 12 Rand because you only pay that fee once for each share that you buy. And if you're buying in bulk, you pay those fees, you bulk those fees out. You don't pay 14 Rand times a million. So your costs of trading on a stock market are really, really low. Relative to buying an over-the-counter product, which is a unit trust or RA or some sort of structured sort of a product where you are paying all those costs, because he's got to pay those costs to the JSE, but he's running his own register and he's running his own custodianship outside of the stock market. Stock market does all of that for you. Markets settle all those problems, and they also give you guarantee. JSE Guarantee Fund and the Central Depository gives you a guarantee that you own those shares. Nobody else owns them. You're not relying on somebody else to give a register. You've got a register run by the stock market with a clearinghouse system and all the rest that does that for you. So it takes away your counterparty risk. And investments can be risky over time. But this trading on stock markets is quite an important addition to globally what's happened since 2008, 2009, where a lot of people lost a lot of money and syndicated loans and all the rest. Around the world, it's authorities are now saying trade on markets, trade on stock exchanges, because then we know what's happening, and we know that these things are now being they're in proper counterparty systems, clearinghouse systems, and all the rest. Now, an index, a lot of people say, well, an index is something that's static. I buy the industrial index, the top 40 index, and that's it. But it doesn't, it changes all the time. Because if there's a company in that index that isn't performing, they'll kick it out the index and a company will come in that does perform. So an index in itself is dynamic. 10 years ago, the top 40 index was 50, 60% mining companies. Now the top 40 index in South Africa is about 27, 28% mining companies. What's replaced that? Industrial companies, property companies, financial companies. So the index itself changes. You don't have to do anything. You own that index through an ETF, and the ETF's portfolio automatically changes without it costing you anything. the cost of the manager changing his portfolio is part of the total expense ratio of that index. Now, you start running that portfolio yourself, you start trying to replicate an index, and you're paying costs as you buy and sell shares to replicate the index. That costs you quite a lot of money, and you've got capital gains tax implications and transaction costs, but there's no capital gains in a trust, which an ETF is. An ETF is a collective investment scheme trust. So the index itself is quite a smart way of investing. That's why you see these old blokes, even older than I am, Warren Buffett and Charlie Munger and Charles Allen, who all started these theories. You can outperform markets in the 60s because markets are inefficient. Markets are run by doctors and dentists and a couple of economists. Now markets are much more efficient because markets are now run by automated trading systems, algorithms and all the rest. Very hard to outperform a market in these days and age. So those old guys that said you could outperform markets are now saying, no, just buy the index. Just buy the market. Because that market is very efficient. The ETF gives you exposure to that index. So that's what a single trading ETF, ETN can do. It diversifies your portfolio because you can buy the whole equity market with a single ETF. You can buy a top 40 index, Satrix 40, Ashburton top 40, or Swix top 40, which is a more structured way of buying the top 40 index. I want to go and buy a global index. I'll buy the core shares S&P 500. I own a little bit of all the top 500 shares in America. I'll buy one ETF and I own a little bit of every one of the big top 500 companies in America. Or I'll buy the DVX World Tracker, which means I now own a little bit of the top 1,600 companies in the world, right across the world. I now own a bit of Google, Yahoo, Microsoft, Samsung, etc., etc. So I can get exposure to a whole market by buying an ETF. And in South Africa, the top 40 index accounts for about 90% of the trade that happens in the JSE happens in the top 40 shares. I can buy those top 40 shares through a single index tracker through buying an ETF. So I can own the market in one transaction, diversification, low costs, efficiency. Or I might just want to buy a sector of the market. I might say I want to be in industrials, I want to be in financials, I want to be in resources. Well, you can buy ETFs that give you those sectoral allocations. Do I want to diversify by being in something different? Let's go and buy gold, palladium, rhodium. What the hell is rhodium? Well, it's a platinum group metal. There's not a lot of it around. And the price is going up quite a bit because China and America and other countries like that are growing and they're consuming platinum group metals. And we're starting to see, the palladium price has gone up 30%, palladium ETF in the last couple of months. Maybe I want to buy oil. I can buy an ETF that gives me exposure to those commodities. Or I can buy something like Smart Beta, which for those of you who study this, the new trend globally is to buy factors, buy risk factors, buy something that reduces my risk, buy low volatility or buy low PEs or buy high dividend paying shares. You can buy that in so-called Smart Beta. You don't have to go and pay a very high fee to an asset manager to go and select me that factor investment. I can just buy that factor investment in Smart Beta products, ETFs, that just give me exposure to high dividend paying companies or low volatility companies and so on. So one of the big factors that's changing global markets is ETFs giving you so-called smart indices. And that's a very good diversifier for you to use in your portfolio management. You can focus in certain areas of the market saying, well, I don't want to have big companies, I just want to have mid-cap companies, or I want to just have high dividend paying companies, or I just want to have property companies. There's ETFs that give that to you as well. And I want to go offshore. I can take my money overseas, pay 7% to the bank to get the money out, go and find an asset manager in the Isle of Man who charges me another couple of percent and all the rest. Or I can just buy international indices on the JSE, the DVX tracker funds, the core shares, S&P Global. I can buy a China fund, JSE, top 130 companies in China. I don't have to take the money out of South Africa. No foreign exchange control issues, no having to full informed, no having to get tax clearance. These are inward investments. This is just like buying Richemont on the JSE. It's a foreign company you can buy on the JSE, which gives you complete exposure to an international market, but in rands. So it's a rand hedge as well. So that's a diversification tool. I can buy a global property fund, the top 40 companies in the world, property companies in the world. Or I want to be in something else like bonds. You go to your stockbroker and say, I want to buy some bonds, and he says, well, go to a bank. But no, you can buy an ETF that gives you the government bond index, the inflation-linked bond index, or high-yielding variable interest rates through preference shares. So ETFs actually give you access to all these different asset classes and all these different types of investments through one exchange and through one type of product. Low cost, easy exposure, and all the rest. And that's something that you can do yourself. You're running a share portfolio, you can be looking at using ETFs as part of that sort of portfolio. So putting it all together, the real way to do wealth management, I think, and I mean most of the theory says, is start with a strategic asset allocation strategy. Now, strategic asset allocation strategy just says, how much money do I have in equities? How much do I have in bonds? How much do I have in property? How much do I have offshore? How much do I have locally? Set up that strategic asset allocation strategy and make sure it's diversified. And all the research shows, and there's some differing numbers, some people say 95% of all long-term investment returns are by just having the right asset allocation strategy. Some people say 85%, but the general number is about 90% of your investment returns over a long period of time is just making sure you're in the right assets at the right time, whilst just making sure you're in all those assets, just waiting for time to work in your favor. So strategic asset allocation strategy, which is something that the asset managers charge you a lot of money for. You know, Alan Gray will charge you performance fees and all the rest for doing a strategic asset allocation. ETFs allow you to do that yourself at a fraction of the cost, because they give you access to all those asset classes that otherwise you would have to buy individual shares to do. The other thing is, and Narina mentioned this as well, your dividends come out every 3 months. All the ETFs pay, or most of them pay dividends, because they're collecting dividends from the underlying shares in the index, and they pay it out to you. Reinvest those dividends. Capitalizing your income in a long-term portfolio is massively important, because that's money you're getting paid out as a return to shareholders. And if you reinvest that, a lot of research also indicates that a big portion, 50% of the portion of a long-term portfolio over 15, 20 years is just reinvestment of dividends. So get used to reinvesting your income. And if you have a platform like ETFSA, we automatically reinvest the dividends for you. We don't charge you extra fees and all that. It's just part of the annual management fee. Very important, that one. The other one, and Narina Pani, I mentioned this one as well, resist tinkering too much with your portfolio. Noise comes out. Something happens on the radio, and some journalist you never heard of, or some analyst from some company you never heard of, comes and says, oh, this is going to happen, that's going to happen. So you immediately go rush out and you do something. And you find that was just noise. So strategic asset allocation, don't play around with too much. That's what active managers do. They play around with their portfolio. They tinker every day. And 85% of active managers can't outperform the index. There's lots of research worldwide that shows that. So I have a strategic asset allocation using index trackers to do that for me. And I don't mess about too much. It's like me. My wife says to me, you fix the TV now, stop messing about with it. It's not working. Don't tinker about it. You tinker about it and it stops working again. So don't keep on playing around in your portfolio. You can make adjustments from time to time because there are changes that sometimes happen in the big picture. But resist tinkering around too much. Resist trading too much. So what's the typical strategic asset allocation strategy? Well, this is just a general one. Let's say we're going to put 30% of our money into South African equities, South African shares. We want 30% offshore. And there's lots of research on this one as well, which says if you put more than 30% of your investments internationally or less than 30%, that really just creates volatility. It creates fluctuations. But 30%, a third of your money in international investments over time is actually the right strategy. It has been the right strategy for the last 20 or 30 years. So have that international exposure, and you can get that through ETFSA and the JSE. Have some money in listed property, high yielding, steady growth, and rentals go up in properties all the time, in shopping centres and industrial centres and so on. Play a bit, maybe have 5% in commodities. And I don't want to be purely in equities and things like property and commodities, so I want to have some money in interest-bearing assets as well, which is not dependent on the equity market going up or down, just pays me interest. And there's that portfolio, and we're selecting a couple of ETFs to give you exposure to those, the Satrix Indy, the FINI, the DivTrax in South Africa, and so on, the core shares, Standard & Poor's 500 US index, buying the world index, buying a Chinese index, and so on. So we select a portfolio of ETFs to give you exposure to that strategic asset allocation. And how has that done over the last 5 years? Well, sorry for all the figures there and so on, but that's that portfolio that I mentioned there. How much we allocate to each of those, 10, 15%, sometimes only 5%. What their return has been per annum over the last 5 years. So we're doing it over a period of time. and the weighted return. And that weighted return for that portfolio would have been about 16.7% per annum over a 5-year period. Is that good or is that bad? Well, let's look at the universe. That ETFSA balanced portfolio, and that's quite a conservative asset allocation. We could do better than that if we wanted to, but that's quite conservative. It's giving you 16.7%. The average unit trusts doing balanced portfolios, high equity unit trusts, in other words, with 60% or more in equities, the average return has been 10.5%. That's a big difference between 16.5 and 10.5. And the very best asset, the very best unit trust over that 5-year period still didn't make 16.76. With some little manager I've never heard of, but he's only made 16.1%. If you go have low or medium equity unit trusts, the performance is even worse. Some people say, well, do you really need a balanced portfolio? Why don't I just put in the all-share index or into the all-bond index? But those have underperformed, those diversified portfolios. So some people just say, I should have just been equities, because over time it'll perform. I shouldn't worry about all these other assets, property, interest-bearing assets, maybe even commodities. But over time, this is a 5-year period, but we could run this back 10 years, you'll find that those diversified portfolios will do better over time. So diversification does work in your favor. To go and put all your eggs in one basket, you want to sit right at the front, just be in equities or just be in offshore. That doesn't really work. This diversification does work. And we can run that over different periods of time, but I think that more or less proves the point. Okay, this is a busy sort of slide, but some people say, well, I prefer numbers to percentages. This one says, let's put 100,000 Rand investment into that portfolio. It could be 10,000 Rand, it could be R1 million. And I'll allocate 100,000 Rand by those percentages. What's the current value after 5 years? If I did this investment 5 years ago, that 100,000 Rand would now be 222,000 Rand. So that's your 16% annual return. But let's also had a debit order running. I put 300 Rand a month in each of these 11 ETFs, 3,300 Rand a month. That debit order investment, because you're buying shares at lower prices and higher prices, you're averaging out, is worth 274,000 Rand. So that's better than the one-off lump sum investment. And the aggregate portfolio is 500,000 Rand. So it's quite a nice return. So your debit orders are adding regular investments. Keep making investments on a regular basis. That's adding to your wealth. So 500,000 Rand, that isn't too bad, because in another 5 years' time, that 500,000 is going to be well over R1 million. And 10 years after that, it's going to be worth something like in the region of 5 million Rand, because of compounding effect. So getting wealthy is often just a habit. Putting money away, even though I haven't got that lump sum, if I can just keep these debit orders going and have 300,000 odd Rand in 5 years' time. And that's the those are historic numbers. Those are actual numbers for the last 5 years. We can't forecast the next 5 years, but we're using 5 years because those cycles do come around in a 5-year period. So you can do this yourself. ETFs, you can go out and buy them. Go and buy them through ETFSA. We'll give you a platform to do this, or you can go and get somebody to give you some advice on it. But this enables you to take control of your investments. So building multi-asset portfolios, do it yourself. We've got the ETFSA investor plan, which you run through a LISP, AOS. You can invest from 1,000 Rand lump sum per ETF or 150 Rand per month in debit orders per ETF. What do they charge? 0.65% per annum management fee. So if you invest 1,000 Rand, it costs you R6.50 a year. So that's not bad. You can't do anything for R6.50. It's not R6.50 up front, not R6.50 a month. It's R6.50 over 12 months. And they only deduct that on a monthly basis. So that's not going to make you poor. So those sort of fees, and there's a brokerage fee of about 0.08 per transaction every time you reinvest dividends and so on, and there's JSE levy straight fees and so on. Over a year, that total fee structure comes down to below 1%. And that's fine, because that's not going to erode your investments too much. So you can do it yourself. There's 76 ETFs and ETNs to choose from, and on that application form, the ETFSA investor plan, you can choose all of those, debit order, lump sum, whatever you want to do. Or you can come to ETFSA and say, I want you to do it for us. And we run this under the ETFSA Investment Services Company, which is a Category 2, an asset management license. It used to be called Resam Financial Services, but it's now ETFSA Investment Services, and it's a licensed FSP asset manager. And we just do bespoke ETF portfolios to meet specific client requirements. Now, those could be very different. Client can say, I want capital gains. Client can say, I want capital preservation. This is my mother who's in an old age home. I don't want to erode the capital. I just want to make sure that your money stays intact and grows a little bit by inflation and so on. I want tax efficiency. I don't want you guys selling my unit trusts every month and creating capital gains problems for me. I want this thing to be run tax efficiently. So I don't want capital gains. I want some of the assets to be in non-taxable assets. I want you to pay me an annuity every month. My grandmother's in an old age home, give her 30 grand a month and just keep the money going for the rest of it. So run an annuity portfolio for me. Or trusts or foundations. Or I want a diversified portfolio. I've got plenty of money sitting in South African assets. I now want exposure to other types of assets, international ETFs, commodities, interest-bearing ETFs and all the rest. So we can run and design those portfolios to meet the requirements of the individual investors. And this is becoming quite a big investment, quite a big business. We do charge you a fee, 1% per annum. Now, some of you have got wealth management services run by private banks and wealth managers all out in the northern suburbs around Dainfin and all the rest. That's a fraction of what those guys charge you. And for that 1%, we pick up all the transaction charges, all the stock brokerage charges. We pick up all the custodian fees, the administration and client reporting. It's online. You can look up your statement every day. We do the portfolio management for you, and we do financial advice and consulting for you. So we'll look at those portfolios on a regular basis and make sure they're meeting the mandates. And we'll sign a mandate with you up front saying this is what you want. That mandate forms part of the advice and what we do in those portfolios. And this is becoming quite popular. Because even if you want to run some of your own money, it's not often a bad idea to have somebody else also doing it for you and see which does best. Or have some money with an active manager. By all means, give Coronation or Alan Gray some money and see over a 5-year period whether ETFSA doesn't do better than they have. The last 5 years we have. You can't guarantee we do better in the next 5 years. But the big advantage for us is we're not charging their sort of fees. And we've got more assets to choose from. We've got a much broader diversification of ETFs to pick from than they have because they're only using unit trusts and shares. So these sort of services are well worthwhile looking at. And we normally look at R1 million and upwards. So, you know, it's pocket money for most of you. But that's the type of portfolio service we can offer. And I think it's important to have, particularly for really wealthy people, to have your money spread around a bit. By all means, give some money to a stockbroker, give some money to an active asset manager, but have some passively managed. Get the overall costs of your portfolio management down and get somebody with different ideas looking at it. We're also doing with a global portfolio, so if you've got money outside of South Africa or you want to take money out, we can help you do it. But once the money's offshore, we can run global ETF portfolios for you. And there's 5,000 ETFs to choose from now, 4,800 or something. So now you've got all sorts of things you can choose to put into portfolios. And we'll run this through a global trading platform. Here again, we've got a strategic asset allocation model, 30% in developed markets, 20% in emerging equities, 20% in bonds. Now, bonds, we're not just buying US Treasury bonds, we're buying emerging markets government bonds. Debt, 10.3% return over the last 3 years. Everybody says international bonds, you can only get 1 or 2%, but once you go into emerging markets, investment grade debt, that looks a lot more interesting. Or an infrastructural bond giving you 6% per annum. What's a big theme in the next 5-10 years going to be? China and America growing infrastructure, not only in America, but globally. Big factor. So those infrastructural bonds, quite interesting. And we put some money in property, 25% in property, 5% in commodities. In dollars, that gives you about an 8% return, and this is quite a conservative portfolio. I know very few people who are getting portfolios run for them offshore and getting 8% in dollars. So that's 22% or so in rands. And the advantage of this is we'll run it through the same mandates that we run our portfolios for, but we'll use an international stockbroker to do the trades. And we'll do it at 1%. And if you can bring me any international manager who'll run a global portfolio for you, balanced portfolio for 1%, less than 1%, we'll match it. Like those adverts, they say, if you can bring me anywhere you can do this for low cost and I can, we'll do it the same cost, because that is very low cost. But you're using ETS, which are low cost structures. So global portfolios is also something that I think will become more important as time goes on, but we can do that as well. Right, so let's finish off tax-free accounts. We all know about these. ETFSA runs them, administered by computer share. We do the asset management. Again, 1%. We like round numbers. We charge you 1% to run your tax-free account. 30,000 Rand, that's the max you can put in a tax-free account. That means 300 Rand a month. Sorry, 300 Rand a year, which is about, what, 25 Rand a month. And that includes everything. So it's not a case somebody comes along and says, oh, well, I've got this with Mutual, or somebody also does 1%, but he charged me 35 Rand a month for debit order, and he charged me this for admin. That's all in that 1% fee. You don't pay for debit orders, you don't pay for transactions. You don't even pay for those. Your fee covers everything. Lump sums, we'll accept from 1,000 Rand, either in the portfolios we give you, or per ETF. If you say, I want to put my tax-free accounts into a single ETF, you can do that. Debit orders we now take from 300 Rand a month. We used to say it had to be 1,000 Rand debit order. We now do 300 Rand a month. We run 4 specific risk portfolios. Or you can choose your own ETF from 41 ETFs that are eligible on the JSE. So you can now go and pick what you want to do for your tax-free accounts. 30,000 Rand per year, limited per individual. But if you've got a big family like Tom Cook there, you can open a tax-free account for every single member of your family. As long as they've got an ID number, South African ID number. 500,000 Rand lifetime limit, but that limit will rise over time. And it's ideal for minors, people who want to build up capital to pay for education, university fees and things like that in due course, because the big advantage of tax-free accounts, no tax on the growth in the portfolio, no tax on interest and dividends, no capital gains tax when you take the money out. You can take the money out of a tax-free account anytime. It's not like an RA where you've got to retire to get the money out. Nice, flexible savings products that are becoming quite popular in South Africa. I think the government's been quite impressed with how this has taken off. Okay, the portfolio choices we'll give you for next year. Last year we only had 3 portfolios. We had a balanced portfolio, equity portfolio, international portfolio. This year we give you an income portfolio. But instead of just putting into savings accounts in the bank, we'll give you as income. This is a money market fund with 10% in it. This is a global property fund that gives you a 5% per annum dividend yield or distribution yield. Tracks, preference shares, giving you about 11% per annum return at the moment, with virtually no capital risk. And PropTrax 10, which is giving you about a 7% yield. So this is quite a nice income yielding portfolio, but it will also give you a bit of capital growth. Because over time, you want to grow this tax-free portfolio to take advantage of the no capital gains tax. So it's important to have some growth. Or we give you a balanced portfolio, which is inflation-linked bonds and property shares and local and offshore equities. Portfolio has changed a bit in last year. The equity portfolio, Satrix Indy, Satrix Resi, Core Shares, DivTrax, DBX World, and the international portfolio where we've got most of the money sitting 50% in the USA. We think that's the market to probably be in. But there's also some money in Euro stocks, Japan, and Global Property Fund. Advantage of those portfolios, if you went and bought that portfolio yourself, paid to buy each of those shares, reinvest the dividends and all this, we offer that straight to you at 1% per annum. Even with 300 Rand a month, then we'll go and split it and put it into that portfolio for you. So it gives you portfolio exposure at very low cost and, of course, under the tax dispensation, which is attractive. But that's using retirement fund portfolios. As all of you know, ETFs can be used in retirement portfolios. We offer 3 different portfolios, CPR plus 3, CPR plus 5, CPR plus 7. Performance, like all other retirement funds, hasn't been great recently, but our cost structures are helping us out there because we only do the total retirement fund at 1% per annum, everything. And nobody seems to be able to get down to that cost. You can transfer in and out of our RA fund, section 14, at no cost. What to avoid in retirement annuity funds? I just want to finish on this because we get so much stuff coming into us at the moment. People unhappy with their retirement funds. Try and avoid, the last thing I want to say, try and avoid multiple wrapper funds. Everybody says umbrella funds are great, but umbrella funds aren't because you're piling all your money into a structure where there's lots of other companies in it. You can't afford your own trustees, you can't choose your own portfolios. You've got all these underlying costs in the wrappers that operate there. Same thing with occupational or professional funds, which are often offered by certain professions. Those things have got too many wrappers around them, pushes up the costs. Don't buy RAs or preservation funds that have got an insurance policy around them. Because you don't need an insurance policy in an RA or preservation fund. When you retire, you can take the money out. So the guys can't give you life insurance because the life insurance is only the value of the fund. So they're selling you a life insurance policy completely honestly. And they're charging you 2% for that. And sometimes to make it worthwhile, they say, oh, we'll give you a disability and a funeral plan and we do all the rest. But that means half your contributions to that RA fund or that provident fund are going to buy insurance. So unless you actually die or get disabled or something like that, that insurance won't buy you retirement. When you get to retirement, it's how much capital is left in your fund. So those things are not all that attractive. And also, in many cases, your contributions to an RA fund are tax deductible. They're only tax deductible for the RA portion. The insurance policy, you can write the life part of it in certain ways, but SARS can challenge us, and they are challenging it. So you're in a very complicated insurance policy wrapped RA, paying a couple of extra % per annum for an insurance policy, and you find that suddenly your tax deductions are not allowed. Or then something happens to me, and I get paid out as an insurance policy, which means that I get taxed. Because if I get paid out of annuity, it's not part of your estate, and there's no tax. So you're giving away a lot of the benefits of a retirement fund, and these things have been packaged and sold to you. And you think you're doing a good scheme in doing that. Or a loyalty scheme. A loyalty scheme says if you stay in a product for a long time, we'll give you a reward at the end. In a retirement fund, you've got to stay until you retire. So you're 35 years old, you can't get out of there till 55 or 60. So why pay a loyalty scheme? I can't get out of this thing early. A loyalty scheme just means that they're taking those funds, that performance of the fund, and they're giving it to you right at the end, the last couple of years before you retire. In the interim, they're keeping that performance, or they're using it to pay commissions to financial advisors. So if something happens to you early on, you get run over by a bus, that retirement fund is worth nothing because the performance fee only comes to you when the loyalty kicks in right at the end. Yet they're charging you 1% per annum or something for that loyalty clause. They've got fancy names from the Cumulus Echo and this and so on. These things are a very bad structure in which to buy, because you have to be loyal in an RA fund, because you can't claim the money until you retire. You can transfer it, but you can't claim it. So avoid those. Avoid having multiple asset managers. Guys say, I've got this RA and it's got 10 different managers and it's got Ford and Allen Gray and all this. That just adds to costs. You're paying for each of those unit trust TR managers in it. One asset manager much cheaper. Platform providers, another layer in the cost chain. Undisclosed costs, portfolio charges, platform fees, administration fees, benefit management charges, that's managing your benefits, financial advice fees, consultancy fees, let's go on, sponsor fees. The guy runs a fund, what does it cost him to run that fund, the call centers and the people he employs, the management of the fund, member share of fund costs. You remember a retirement fund, you've got to pick up the costs for running that retirement fund, being audited, etc., and compliance. All those are fees in a retirement fund, and nobody gives you those fees. So go and look very carefully at the terms and conditions, or come along to a financial advisor and we can help you on this and just look at those costs. Now, in ETFSA, we say that 1% covers all of that, and it does. 1% cost covers all of those fees we absorb in that. And that's quite hard to do. You've got to be a small company without salesmen, without distribution. You can't advertise on TV. You can't sponsor the side that's coming last in the National Football League. All those distribution costs are what make retirement funds expensive. You don't have distribution costs like us. You don't have those sort of fees. Okay, so that's contact details. You know how to get hold of us, but please contact Narina, myself, or all the girls outside. Thanks for your